When you're investing in a mutual fund, I want you to watch out for one line item on the prospectus before you buy it called expense ratio, because that one line item may be eating up all your cash. Hey, I'm Jay Lieberman over here at the Real Estate Minute Show and Lieberman Realty Group. I first want to give a quick shout out to Fabula Coffee that is helping to support the continuation of this show. This is episode 199. We're going on 200, baby. We started this show before COVID, so it's insane, and I love it, and I love you guys for being here. Fabula Coffee, though, has helped support this show now, and I came to find Fabula Coffee because I got super acid from regular coffee. Fabula Coffee has very, very low acid, and they make it specifically for low acid seeking people like myself. There's also, as I research coffee a lot more, there's a lot of mold and fungus and all kinds of weird crap in coffee. It's also a lot of unfair trade practices and people making a dime an hour and all that kind of stuff. Just terrible stuff that goes on in this industry. Fabula Coffee gets rid of all that. It's all fair trade. It's all mold-free, fungus-free, clean as hell, and low acid. I love it. And you could try all different kinds of flavors that they have. Thank you again to them for supporting the show. And I will put a link. They actually offered a discount to my listeners. So you can click that link and grab a bag, see what you think. Anyway, back to the show. The expense ratio, one of the most important parts of looking at a fund to invest in, okay? I highly recommend, by the way, that you invest in some broad spectrum index fund. We've talked about it numerous times here. And even Warren Buffett, the Oracle of Omaha, arguably the smartest investor the planet has ever seen, has also recommended numerous times to invest a large chunk of your investable cash into broad spectrum index funds because we don't really know where the market's going. The experts know better than we, and we also have day jobs, so let them take care of it. Don't day trade. So you can go to your favorite platform, Schwab, T. Rowe Price, Fidelity, Vanguard. They all have great internal funds, and I want you, when you go look at it, look for either a total stock index fund or an S&P 500 index fund to get you started. That'll give you a very broad spectrum, if not all of the stocks in that particular index, and you will pay a fee to the managers every year to have access to that fund. And that's fine. I'm willing to pay the managers. My Schwab fund, for instance, one of them that I have is a S&P index fund. The expense ratio, which is the money I pay every year to the managers, is 0.02%. That says 0.02% is if I put $1,000 in, it's costing me 20 cents every year. Very, very small expense ratio or expense fee. If you go to some others, you'll see 3%, 2.5%, 1, 0.5, all over the board, okay? It's even money managers that will charge you 10, 20%. I just want to make you aware of that line item because people don't pay attention to it. They forget about it and what it really means. And if you put in $10,000 into a fund, for instance, that you worked your butt off to get, and you're paying 3% as an expense to have access to that fund, that's $300 a year. So the market has to go up over 3%, your fund does, in order just to break even. If you have a money manager charging you 10% of that $10,000, let's say, that's $1,000. I mean, the market has to go up over 10%, or you have to make over $1,000 every year just to pay your fee. So the lower the expense ratio, the better. And please pay attention to it when you're looking at your next fund. Have a great week. We'll see you next Thursday on the show.